Hey Vid, welcome back to our show. I'm Maya, and I have to say, I'm loving the news today. SpaceX IPO is about to start trading, and the Dow is rising on Iran peace deal hopes. What's your take on all this?
Yeah, so here's the thing, Maya, all this news is interesting, but what I want to talk about today is something that really matters to our listeners, and that's what compound interest does to your money over time. It's like a superpower for your savings.
Wait, compound interest? Isn't that just a fancy term for earning interest on interest? Haha, I'm not even sure I understand it, Vid.
Great question, Maya. Yeah, it's basically that, but let me explain it in a way that's easy to grasp. Imagine you put $1,000 in a savings account that earns 5% interest per year. That's like putting your money in a coffee shop and earning a free pastry every year. But here's the magic part. The next year, you earn 5% interest on the new total, not just the original 1,000. So it's like getting free pastries on top of free pastries.
Oh, I see, so it's like a snowball effect. The interest earns interest, and it just keeps growing, right?
Exactly, Maya. It's like a snowball rolling down a hill, getting bigger and faster, and the earlier you start, the more time your money has to grow. For example, if you save $1,000 a year for 10 years and earn 5% interest, you'll have around $13,000, but if you wait 10 years to start and then save for 10 years, you'll only have around $10,000, so it's all about starting early.
Whoa, that's a big difference. Vid, I had no idea. So what's happening right now in the market that affects how our money grows over time?
Okay, so the Fed just held rates, and the tone is still hawkish, which means they're not expecting to cut rates anytime soon. This can affect how much interest you earn on your savings and how much you pay on loans. For example, if you have a credit card with a high interest rate, you might want to pay that off ASAP, but if you have a savings account, you might be earning a decent interest rate, like 5%, which is close to the 10-year Treasury yield.
So what happens next, Vid? Are we going to see a big change in the market? Or is it going to stay steady?
Great question, Maya. Well, if the economy stays strong and the Fed keeps rates high, we might see a slow and steady growth in the market. But if there's a surprise, like a recession or a big change in the global economy, we could see a big drop. For example, if the Iran peace deal falls through, oil prices could spike, and that could affect the whole market. But if the deal holds and oil prices stay low, that could be a boost for stocks like airlines or companies that rely on oil.
Okay, so it's like a big game of if then, Vid, and we have to be prepared for anything. But what are the chances of each scenario? Can you give me some numbers?
Right, Maya, I'd say there's a 60% chance we see a slow and steady growth, a 20% chance we see a big drop, and a 20% chance we see a surprise boost like a big tech breakthrough or a new deal that sends the market soaring. For example, if SpaceX's IPO takes off and they announce a new project, that could be a big boost for the stock and for the whole space industry.
Exactly, like a moonshot, Vid, okay. So what's the bottom line? What do our listeners need to take away from this conversation?
Yeah, so here's the thing, Maya. Compound interest is a powerful tool and it can help your money grow over time, but you have to start early and be prepared for surprises. So make sure you have a solid plan and you're not putting all your eggs in one basket. And always remember, this is educational only, not financial advice. Don't go out and buy a bunch of stocks just because we talked about it. Do your own research and consult with a pro.
Right, got it, Vid. Thanks for breaking it down for us. And for our listeners, if you want to learn more, join us on Discord, and we'll keep the conversation going. Oh man, I learned so much today.
Yeah, me too, Maya. It's always fun talking finance with you. And to our listeners, thanks for tuning in, and we'll catch you on the next episode.